Hey, what's up? It's Omar from the Bullish Bears team, and I'm doing a video about momentum trading. So I'm going to give you an overview of what's momentum trading, how it works, what are the things you need to know in regards to momentum trading, how I find my strategies, how I find my plays, and just, general overview of momentum trading. I did a previous video on momentum trading, but I knew the sound sucked, so I wanted to do it again and kind of give you a couple of more tidbits in this video as opposed to the one I did in the last video. So again, what's momentum trading? So momentum trading is traders focus on stocks that are moving significantly in one direction on high volume. Momentum traders may hold their positions for a few minutes, a couple of hours, or even the entire length of the trading day, depending on how quickly the stock moves when it changes direction. So momentum trading is otherwise known as day trading, right? So basically when I place a trade, I'm placing the trade based on my assumption that either I think the stock is going to go up quickly or down quickly. And I try to make my money in minutes. That's what momentum trading is in a nutshell. Okay. You have other types of trading too, because I get a lot of questions from this in the group. There are people who trade options. So options in a nutshell is just basically you buying a contract, right? And when you buy that contract, it gives you equals to 100 shares because you think the price of the stock is either going to go up or down over extended period of time. So, you can talk to some of the other members in the group about options trading, and it's very, very different from day trading. Options trading, you're more or less trading over a period of time. Day trading, you're in and out of a trade in a few minutes. Okay? So, what causes a stock to move up or down in price? So, news, generally, it's like some sort of catalyst, like news, earnings, some type of investor, okay, usually like a billionaire. A sector becomes hot. Today, I'll use sympathy plays is when a stock price goes up or down based on another stock in the same sector, having a big move in one way or another. Example, the shipping and wheat company sectors this past month. Actually, today, which is December 15, 2016, for whatever reason, the shipping companies took off again, and that's a perfect example of a sympathy play. I'll talk about one of the stocks I traded that wound up going up in price exponentially, but I took it for a loss, and I'll review that trade with you guys. All right, so what do I do? What do I look for when making a trade? I look for patterns. That's it, guys. That's why I like trading momentum or day trading, because it doesn't involve a lot of thinking. I mean, it's pretty straightforward. You're just looking for patterns and you're trading patterns. What types of patterns I'm looking for? I'm looking for breakouts, stocks that are making new daily, weekly, or monthly or yearly highs, breakdowns, stocks that are making new daily, weekly, monthly, or yearly lows, dip buys, buying a stock after a major sell-off as close to support as possible, usually happens after a morning panic at the market open, red to green plays, which is a stock price that increases over the previous day's close price, and green to red, a stock price that decreases below the previous day's close price. That's all I look for, guys, is patterns. I'll give you a quick example, and I'll go into it in more depth. So, was a stock that closed today, holding its highs, right? Super simple example of a breakout. And I'll go into more detail, right? So right here at this point, and at this point of the day, this was at 138. At 138, the high of the stock was 470. It closed at 467, right? So if you're watching the stock and it's sort of in play for the day, all you do, right, to get a sense, you just add a trend line. So you go here, and you go and you add a trend line right here, right? And all you're doing is looking to see if the stock breaks out. So once it broke this day's high, which is 476, that's a breakout. That's a daily breakout, right? So what I look for, breakouts, daily, weekly, monthly, or yearly. And that's what happened. So when it broke the day's high, it shot up. It went, and at this point it's at 470, 474. It closed at 563. Incredible. Okay, could have made almost a full dollar for every share you bought. Right? So if you had bought 1,000 shares of this, you could have made close to $1,000 if you held it all the way the entire day. Okay, That's one perfect example of a breakout. All right, and that's why people got in. The volume push was driven upward because other people are looking at this. All right, and that's kind of how they play these stocks. Okay, and just zoom in so you can see it even more detail. Look, that's the line. People saw it broke its day as high, and they just got in. And I'll talk about, these are different indicators that I'll talk about. But and they just rolled it all the way up. Okay, it's that simple. Okay, now it's not easy, but it is simple to identify, breakout and breakdown patterns. Okay, so there's other types of patterns though in correlation to the breakout and breakdowns. So additional patterns to learn, you go to stockcharts.com and they have all these different names like double top reversals, double bottom reversals, head and shoulders, bottom reversals. I actually shorted a stock today, NUGT. I shorted it based on this on what is it called? Double. It was actually double top. Where is it? I'll show you. It's actually on my next screenshot. Let me go here. So these are these screenshots here. These actual names. These are the actual screenshots of them. So what I traded today was NUGT based on this double bottom. Actually, I'm sorry, double top. Double top. There was a double top, and based on the double top, I actually sold, and that's a bullish sign, a bearish sign. So every time you see a double top, that's usually a sign that the stock is going to sell off. Now, there's no guarantee that whenever you see any one of these patterns that the stock is going to do what you expect it to do. But they're all helpful, okay? Because no trader in the world knows whether or not a stock is going to go up or go down, okay? If they're telling you that, they're full of shit, all right? Nobody knows. They just look for trends, and based on trends, they get a sense of with the direction that the stock is going in, all right? These all help, and basically these are all breakouts, all right? So all these bullish patterns, this flag pattern, it's a breakout, all right? It's a pattern that helps go up, right? It's buys. These are all buy signs, okay? You see how they're going up, going up, going up. These are all breakouts, okay? And then these all breakdowns, okay? Bearish. Bearish means the price of the stock is going down. And when you see these patterns, you get a sense of whether or not the stock is going to go up or it's going to go down, all right? That all goes back to what I talked about initially about what I trade, right? Breakouts, breakdowns, okay? All right. Also, just so you know what red to green and green to red means, just so I can go back to it. Very simple. I'll use NUGT. So NUGT, okay, you see this line here? So the line signifies or indicates the previous day's close price. So when a stock dips below the previous day's close price, that is a sign of bearish sign, meaning the expectation of the price is the price of that stock is going to go down. So today, had you been watching this stock, all right, and this signifies pre-market at around, I want to say, what does it say? Around 8 o'clock or 9 about 9:15, this stock dipped below its previous day's close, and you could have put in a short order, meaning, and I'll get to that, but shorting a stock means basically you're borrowing shares from your broker because you think the price of the stock is going to go down. So you borrow the shares and you buy the close whenever you want to close that position, meaning you're actually buying the stock at that point. I'll talk about that in more detail. But this is an example of a green to red play. Like it closed yesterday, okay, at 691, all right, and it's currently now 593. So if you would have shorted it and held it all day, you'd be up about $1. Okay, close to $1, 98 cents you made for every share you shorted the stock. All right, which is pretty incredible. A red to green play is this. So dries, right, at the market open, right, it closed the previous day at 355, right? So it went from, and look, this was at 8. This was right before the market opened. All right, it was below the price, and when the market opened, okay, it actually broke that sign, and that was a buy sign. That's why you got the volume push and the price of the stock went up. Okay, it went up almost $2 today. All right, so you could have made some good money. I actually lost some money today on a failed breakout, and I'll talk about that later. But you know, that's an example of red to green. So that basically, again, what it means, red to green means that the stock goes above the previous day's close. So you could have bought right here and put a stop loss to say, hey, if the price goes below, you know, through the previous day's close, which is 355, just sell my shares. And you could have just held this all day, and you'd be up, you know, almost $2. All right, so you could have made some good money. All right, so getting back to my PowerPoint. So again, these are the patterns that we talked about. So now let's talk about that. And I just alluded to it a second ago. There's two ways to make money trading stock. You buy and you sell, which is, and that everybody can relate to that, right? You buy a car for $1,000 and you sell it for $2,000. You just made yourself $1,000. Well, same thing with stock. You buy a stock for one price, you sell it for a higher price, hopefully, you make some money, right? So if I buy stock ABC at $1 and I sell it at $2, okay, I made $1 for every share that I own. All right, it's very simplistic. That is, and I think that's something that everybody can relate to, right? So if I bought this stock at $3.55, okay, and let's say I decided to sell it at $4.55, I made $1 for every share I owned. So if I owned 100 shares, I made $100, right? Very, very simple, okay? I think most people can understand that. Shorting is what people kind of lose their head over. It's the opposite of buying and selling. Shorting, again, means you borrow shares of a stock from your broker because you believe the price of that stock is going to go down, okay? And then you buy the cover because you're ready to buy the shares at the stock, hopefully for a profit. And, you know, so selling short, buying a cover. And basically what that means, again, right? So let's assume I'll use something simple. I'll use so let's assume you were watching this stock, right? And at this point, this stock closed at 537, right? Actually 543. And let's assume at this point you think the price of the stock is going to go down. So you short it, meaning you would have came here. Oops, let me go back. Sorry, guys. And you would have said, hey, I'm going to take 100 shares of this stock at this price, right? At this price, at the close price, which was, at the close price, which was 543, right? In this candle, you see up there, it says 543, right? So let's assume you would have got it executed at 543 and you got 100 shares. And then it went from 543, and then it closed at 535, and then it closed at 516. So let's assume you shorted the stock at $5.43, right? And then you see it hit, you know, it's close, it goes down as far as 516. And the next candle, it starts gapping up. So you decide you want to buy the cover at 520, right? So 543 minus 520, oops, let's go this. Sorry, I'm terrible at math. 543 minus 520 equals 23 cents. So when you buy to cover at 520, right, when you closed, right, because you shorted the stock at 543, you covered at 520, right? You covered at 520. You put the price 520. When you covered, you made 23 cents a share. So let's assume, right? Let's assume you had, you know, 1,000 shares that you shorted, right? So if you would have shorted this stock 1,000 shares and you covered, right? So you shorted at 543, you covered at 520, you made 23 cents, right? You bought the shares, you borrowed it at 543, but you bought it at 520, right? So that's the price you're actually going to pay for the stock. So it's less than what you bought it for, and that's shorting basically. You're thinking that the price of the stock is going to go down, okay? So you borrow the shares at one price and you cover at another price. And if you covered at 23 cents, and let's say the assumption was 1,000 shares, I put 100 here, but let's say it was 1,000 shares, right? So you would have essentially made, right, and you say 1,000 times, right, 0.23, you would have made $230. And you would have made $230 and just to show you why I love day trading, is because you would have bought this, and the time that you would have shorted this, let's assume that you would have did this, it was at 3:48 p.m. At 3:49 p.m., you're covering. Okay? So in 1 minute, you could have made $230. Just like that. It's that quick and that fast to make money. Now, you notice I said 1,000 shares, right? So if you had bought 1,000 shares and the price of that stock was at the time, then the example we used was 540, 543, okay? Then you're paying 1,000 times 543, all right, which is about, I don't know, over $5,000. So some of this can be pricey. It's all relative. It all depends on the price of the stock and what you're willing to pay and all that kind of stuff. So that's shorting and buying the cover. If it doesn't make sense, still, just ask me in the group and we can talk about it in more detail. And shorting is not as simple as buying. Like when you buy a stock, you own it, right? So if I buy a stock, if I buy this stock right now, it's currently at 538. That's the price of the stock right now. That was the high. But right now it's after hours, so you could technically trade up to like 9 p.m. But let's say I bought some shares. Right now there's some bid and ask, and we'll talk about this. But let's say, right, I bought the stock at 538. I own this stock forever. So if it goes down to $1, if it goes up to $100, I own it until I decide to sell it. If you short a stock, your broker will close you out. So let's say you shorted the stock at 540 and the stock goes up to 550, 560. Now it's going up. It's going the opposite direction. What the broker will do is they'll see how much money you have in your account, and if they see that you can't cover, right? If you can't cover for the losses, they'll automatically close your account. All right? Or you can't, when you borrow shares from your broker, at some point they're gonna cover you. They're gonna close you out. Okay? You can't like short, say, well, I'm just gonna buy these shares, and I know these companies are dog shit, so the price of these companies are gonna go down, so I'm gonna make money. Well, you can't like hold until that happens. At some point, your broker's gonna close you out. Usually, they let you hold for like 2 days, 3 days. Just really depends. Just really depends on the broker and the circumstances surrounding the stock and how much of that stock is available. So all those things play a role. All right. So that's the difference between buying and selling, and then shorting, selling short, and then buying to cover. Okay. So what I always do, momentum traders trade. So I generally trade from 9:30 to 11, and then sometimes 2 to 4. Why? Because that's when the most volatility happens in the market. And let's look at this stock, Drives. And let me move this over just to make it nice and easy for you guys to see. Look what happens. So let's go. I'm going to do the 1 day, 5-minute chart. Okay, this is the open of the market. If you notice, most of the volatility tends to happen in that first hour. So so this is we look at this 9:30, all right, and it went from at 9:30. This opened and it closed at 392, right? It bottomed out at 383, and that was about, and this time was at 9:40. By 10:20, it was back up to $4.40. Okay, now the reason why there's more volatility is because everybody's trading at the market open, right? And usually by like 11:30, people are, they're going to run the errands, they're doing the things they got to do, and then they come back. Usually they have lunch, whatever, and then usually 2 to 4, that's when a lot of volatility happens. And look what happened. It's usually, I usually say be at your computer back at around 3 o'clock, because look what happened. At 3:05, this stock broke the high of day, and it just ripped all the way to 4. And if I go watch, I'll go to another chart. Look at Sino. Look what happened. Look what time this was. 3:25, and look, it ripped at the end of the day. All right. Yeah. So stocks, right? If you're gonna do day trading, especially if you have this is my advice. If you can day trade between 9:30 and 11, that's all you need to do. Really, 9:30 to 10:30 is really all the time you need to trade. And if you got a substantial amount of money in your account, let's say you can trade with like 10 grand, 10 grand or more. I mean, you can make a significant amount of money, trading for the first hour of the day. You make your $500, your $1,000, whatever your goal is. My goal is usually to try to make $1,000 to $2,000 every day when I trade. Obviously, that doesn't happen. I wish, but that's my goal. So far this week, I'm up close to 10,000, about $10,000. But that's not every week. Some weeks I'm up and some weeks I'm down. It just really depends. I had a couple of big winners this week, but that doesn't happen every day. But the reason why I make money is because I make sure I cut my losses quickly when a stock is not doing what I need it to do. You can be like right only 50% of the time and still be a very profitable trader, because when you're losing half the time, you're losing small losses, because you're cutting, you're managing your risk. All right, it's all about risk reward. Okay, and then when you're making your money, you're making good money, and so it adds up. You're making more than you lose, so your account goes up. All right. So with that said, I use what we call technical indicators. I use Thinkorswim, and these are the technical indicators I use: the 9 and 20 exponential moving averages, right? So and I think somebody in the group asked what that means. So this is what I suggest to everyone, right? If you don't know what the hell exponential moving averages is, you just go to Google, right? You type exponential moving averages, right? EMA for short. Here it is. What's an exponential moving average? An exponential moving average is a type of moving average that is similar to a simple moving average, except that more weight is given to the latest data. It's also known as the exponentially weighted moving average. This type of moving average reacts faster to recent price changes than a simple moving average, and that's why traders use the EMA. It just gives you a better sense of what the value of the actual stock, the price of the stock, is worth in real time, because it moves so fast when you're day trading. So a lot of traders use what's called the exponential moving average. All right, and you'll get different, people telling you what numbers they use, but generally, I'm sorry to go back. Generally, traders use what's called the 9 and 20 EMA. So I'm in Thinkorswim right now, and if I click this little beaker, it actually pulls up my study. So I use the 9 and the 20. I also use something called VWAP, right? So I have it here, VWAP. So what the hell VWAP means? If you're not sure, just go to Google, type VWAP. And you should be watching videos on this too. What is VWAP in stocks, right? So here it is. In finance, volume weighted average price. It's the ratio of the value traded to total volume traded over a particular time horizon, usually 1 day. It is the measure of the average price at which a stock is traded over the trading horizon. So people use this to kind of get a sense of where the stock is. And the way I have it set up, so my VWAP represents the green, and my 9 EMA is represented by the blue, and you can see it here. And I got my 20 moving average here. And then I have my simple moving average, which is I use a 50-day simple moving average. And I got it set up here. Oh, I got this wrong. Oh, I need to fix that. I had it on 40. I'm glad I'm doing this video. Apply. Hit OK. All right, and I also use the simple moving average, right? So the simple moving average, and I have the 50 as well as the 200. So you're like, what the hell is that, right? So let's just type simple moving average. And I bet you if I type simple, Google's crazy, kind of figures out. There it is, simple moving average, pretty remarkable, right? A simple moving average is an arithmetic moving average calculated by adding the closing price of the security for a number of time periods and then dividing this by the total number of time periods, right? So it's just basically, like the averages, like you learn in school, right? You take 10 days, you take the total, you take 10 numbers. So if I did 10 plus 10 over 10 days, and I took that and divided it by 10, it would give me my average. That's what the simple moving average is. It's just a simple moving average. But it's important to use these because they act as support and resistance barriers. And we'll talk about what support and resistance means for those of you that don't know what they mean, right? But I also look at something called the relative strength index, which is RSI, okay? The RSI is this. And basically what it tells you is when a stock, so the numbers vary from 0 to 100. So when the number here is between 70 and up, that means a stock has been overbought, and that usually means the price of that stock is going to go down a bit, all right? And when it's between 30 or lower, that means the price of the stock is oversold, and at some point people are going to start buying it, and it should drive the price of that stock up. That's what oversought and overbought and oversold means. So right here, if you notice, right, the RSI is above 70 and it's red, it's hot, right? And if you notice, it's around this time here, about 10:15, and what happens? It reaches a peak of 330, and it kind of starts selling off. And you notice it goes from like 330 all the way back down to like 319. Okay, The RSI is there. It's an indicator that it's been oversold. Okay, that's sort of how I look at this to get a sense when it's in here. I'm like, okay, there's gonna be a pullback at some point. All right, it could be a big one, it could be a small one. All right, but that's what RSI is. Okay, relative strength index. All right, without going into all the detail, that's basically what I'm doing. I'm looking at this to see if it's been overbought, okay, or oversold. All right, oversold is the opposite when it dips below 30. Okay, all right, all right, so let's go back. So that's the RSI. All right, and again, if you're not sure, you can just type RSI and just see what comes up. Relative strength index. There it is, and you can click it and you can read it, and it tells you. I'm not going to go into all this. It's just what I explained to you is exactly what it does. You can you're going to have to take the time out and study this stuff. Okay, what a MACD to line. So without giving you the technical definition of it, just to tell you how I use it, and I think this is the best indicator of all the indicators. Basically, what it means is you have two lines, right? And I set this up to make it very easy for me to follow. I set it up so that the green line represents like a stock going up. The red line sort of represents the stock going down. And what happens is when the green line crosses over the red line and you get this sort of separation, that is a very bullish sign. Bullish means the price of that stock is going to go up. And look what happens. The market opened, right? And it opened at 295. The high was at 280, 301, and then it closed at 286, right? And then you have these what's called, let me zoom in here. These are called wicks. And basically what wicks mean, wick candles are, they're like, it's like telling you, like, basically buyers and sellers are like even. So it's the stock is kind of staying at the same price, and the stock doesn't know what it wants to do. Look, right? So it opened at 287, it hit a high of 288, it hit a low of 285, but then it closed back at 287 because it doesn't know whether or not it wants to go up or down. That's what basically the wick candles represent. All right. And then if you notice here, right, so we're looking at the MAC 29. Look, the green crossed over the red, right? And you see it here, and that's kind of going up, and then it kind of went up, and then it closed. And then it's kind of running parallel, but the green is still above the red. But look what happens. You start getting some volume, meaning some buying pressure, and then the candles start separating, and look how it went up. It went from a close of 290 all the way to 332 in a matter of, and this was 9:45, and by 10:20 it was up at 3. So you could have made over 30 cents, all right, in a matter of 30 minutes, okay, maybe 40 minutes. But that that could be a little or a lot. So let's say you would have bought, like, let's say 5,000 shares at 30 cents, right? All right. So let's say you would have bought this stock, right? Let's say you would have got executed at 290. Just making this up, just so you can get a sense of how this works. 290, right? And let's say you bought 5,000 shares, right? So you paid $14,500 for the stock, right? It's pretty expensive. But you're gonna put a limit, right? So let's say you would have got executed at 90 cents, and let's say you're risking 10 cents. So if you take 5,000 shares, type 100. If it doesn't go your way, 5,000 times 10. Oops, sorry. 5,000 times 0.10. Oh my God. 5,000 times 0.10. $500. All right. Okay. Now, so you're risking 500, but if it goes your way, right, and you're expecting to make 20, 30 cents, right, and let's say you got executed at 290, and let's say you sold, you see it break through. Let's say you sold at 320, all right. So you made 10, 20, 30 cents, right? So if you would have risked, right, 5,000, and you would have closed at times 0.30, you would have made $1,500, okay? And you would have did that in a matter of 30 minutes, okay? So and obviously that's a bigger position size. Most people do a few hundred shares, so you're making $100, $200. But if you got some money to play with, you can make some serious money trading these stocks, you know. And obviously, you're only gonna get executed if you have volume. Like this stock didn't have a ton of volume in the market open, but if you do, like in this candle, it was like 26,000 shares were bought and sold in that 1 minute time frame. Okay, so in this 1 minute time frame, it was about 34,000 shares. So you know, 5,000 could be a little or a lot depending on the stock and how much that stock costs. All right, and basically people bought this on the breakout. So this was the high of day at that point, right? And remember what I talked about buying breakouts. So right here, let me zoom in. Right when it broke this candle, this technically became the breakout, the high of day, right? And we talked about what do I trade, all right? I look to make a trade, breakouts, new daily, weekly, or monthly highs, right? So if you're looking at it, and traders were looking at it, once it broke this, traders, that's why the buying pressure came in, because people saw that it broke the day's high at that moment, and it drove the price of the stock up, all right? All right, so I'm hoping this makes sense. All right, so getting back to, zoom out, and getting back to my PowerPoint, what other things? So that's the MACD 2 lines. And just so you know, just to continue talking about this. So, right, you see it go up, right? And I told you, when these are separated like they are, that's super bullish. That generally means the price of the stock is going to go up. But you know, because the RSI is over 70, that at some point it's going to pull back. All right, so you got to be you got to be quick to sell those shares. You don't want to hold them, okay, if you're trying to make a quick profit, all right? And then you're going to notice, look what happens. When it hits here, it starts rolling over, and you see the green, right? You see the green go below the red. So that's a bearish sign, and it sells off, okay? And our side dips below, okay? And then look what happens. It goes from green to red, and look, it jumps. Right here, it's at 325, and it gets as high as 348, okay? So you could have got in here, made some money, all right? And then it was very bearish. So look at how the red, right? The green goes below the red, and it kind of like sells off and consolidates. So over here, it's at 351, and by here, it's back down to 324. Okay, all right, and you see it's all the way down. Even though this kind of got there a little bit, it's still sold off. It's the indicators were correct. And then look what happens. The green goes above the red, and look what happened here. It ripped to the close. Okay, it went from 341 to 4 what was the close there? 410. Okay, so 341 to 410, right? 345 to 410. I mean, you could have made some money there. Okay, you could have made more than 50 cents a share if you caught this. All right, and look what happened, right? I said we break out, we buy patterns, right? I buy patterns. So if you notice, at this point, this is the high of day, and what happened? Started getting some buying pressure, it broke the day's high, and it just ripped to the close because other traders saw this and they went in. And it's above the indicators. So I didn't really go into a lot of detail, but basically, when a stock is above the indicators, that means that it's a bullish sign. That means that generally means the price of the stock is going to go up. And when it's below the indicators, that means the price of the stock is going to go down. Okay? It's not always that simple, but you know, in simplest terms, that's the best way I can explain it. What you're going to have to do is go to YouTube and watch videos on all these different indicators, all right? I can't simply just explain them to you, all right? And then the last one is the histogram. The histogram is just sort of like a color, it's a color-coded representation of what you see here. So when this is light green, that means that's a bullish sign. And you notice here, that's the price of the stock's going up. And then when it starts getting darker, it's stepping down. So a darker green means that it's getting bearish and the price of that stock is going to go down. When it's light red, okay, that means that it's strong bullish. All right, it's like at its strongest bearish. I'm sorry, that means it's strongest selling pressure. And then when you see like this darker red, that means that you see how it's light red here, and you see how it's just selling off, and then it's kind of like stepping up, so it's getting more like a burgundy. It's getting like darker. That means like the selling pressure is decreasing, okay, and it's aligning with the lines. And then if you notice, once it starts getting super light green, that means it's buying. People are buying. And then you see how it's getting darker green. That means that it's starting to sell off. So that's what the MACD lines. And this all just helps me get a sense of the direction of the stock and how it's going to work. There's no guarantees in any of this, folks. All right. You know, all this stuff helps. There's no guarantees in any of this sort of stuff. These are just all indicators that help you get a sense of where the stock is going to go. I mean, that's all that it's telling you. All right. Another thing that we should really talk about that you really need to know is what is support and what is resistance. Okay. So this right here, this is considered resistance. So the highest point, the stock at its highest point in a daily chart is its resistance. Okay. The lowest point would be support. All right. So right here, right? So for the daily chart, we're looking at a daily chart. All right. This at this point, let me just remove all this so you can see. Let's oops, hide all drawings, add a drawing, remove all drawings. Yes. All right. So think of this, right? We're looking at the first. Let's say we're looking at this first, you know, the market opened at 9:30, and by here it's at 12, right? So let's say at this point, this right here, because it's the highest point of the day, this serves, and if we add a drawing, this serves as resistance, meaning it's the highest point of the day. All right, it's the stock at the highest. The stock at its lowest would serve as support, as support. So this would be support. So if I'll add a drawing, make it easy for you guys to see. This is support and this is resistance. Okay, but you notice that as the stock of the price goes up, okay, it's kind of holding its number, its price here, right? It's not going back down to the day's low. So at this point right here, this is serving. At this point, this is serving as support because this is the new support level because it's not back down at this price. It kind of rolled up here, and then you see how it kind of gapped up here the rest of the day, and you see now this is the channel. This is resistance. This is support, and if you notice, it's like going through this channel the rest of the day. And then look what happens. If we look through the channel, right, at this point, this is again support and this is resistance. And when it breaks the resistance point, that's when the price of the stock starts going up. That's when all the traders start buying because the pattern, they broke that pattern. Remember what we look at. And this is what all the stock traders look. They look for patterns, okay? They look for breakouts, breakdowns. This was the breakout, right? This was a breakout. Okay, and that's what traders are looking for, guys. It's kind of that simple. All right, it's not you know, don't let people fool you, all right, and make you think they're just these geniuses. All right, they're looking at patterns and they're just looking for patterns. I mean, that's pretty much what they do. That's what traders do. All right, so with that said, all right, these are the actual indicators that I use in Thinkorswim. Okay, and we also, this is just a screenshot of it, so I showed it to you. Okay. I showed it to you, all right? So if I click the beaker, here are my strategies, all right? Here are my studies, all right? And I did a whole video on how to set this up, all right? So I'm not going to go into it, but I got a whole video on how this is all set up, all right? So you can watch that video, and it goes into more detail about how all those things are set up, all right? So, all right, so again, we talked about the indicators. I went into detail about this, but I didn't talk about level 1 and level 2. So we talked about support and resistance, right? So here it is. This is the breakout, right? Here's the breakout. This is resistance. This serves as support. This is actually a breakout, an earlier in the day breakout, right? This over here at this point, this would be support. All right. It's the low right here of the day, right here at this point of the day. All right. But we also got to talk about this. This is the time and sales tape, and this is level 2 and level 1. So going back here, I just gonna click these two buttons, time and sales and level 2. And let's look at a stock maybe that's doing a little more, has a little more information. So, and I'm gonna click level 2 so you can see. So, what this represents, this is the time and this is the price and this is the amount of shares that people are either buying or selling. So, as of 4:01, somebody sold 500 shares of this stock Drives at $5.38. All right. At 4:04, somebody also sold 400 shares at 5.38, and then at 4 o'clock, somebody bought, I mean, so sold 977 shares. And you see, so this, it starts like here. This is like the most recent, and this is the latest. So this started at 356. Somebody bought 530 at, I'm sorry, they bought 967 shares at $5.39. All right. And you can see people getting executed at 539 all at these times, right? At 356, and then 357, a few people bought 358, 359. And the reason why that's important is because it gives you a sense of the price direction. That's why you kind of watch time and sales. You know how many people are buying how many shares of the stock. And if you got more sellers, right? So if you see more red than green, that means the price of the stock is going to go down. If you see more green than red, that means the price of the stock is going to go up. And what you do is down here, when you click that level 2 button, down here you see the name of the actual company, you see the price, and you see what's called the bid and the ask. This is level 1, okay? The name of the company and the price. Level 2 is this, all right? It's the market depth, right? It's the bid and the ask. So the bid means buyers, all right, who are looking to buy the stock. The ask are sellers who are looking to sell the stock. So when you have more buyers, bidders than sellers, the price of the stock goes up. Right now we have more sellers than buyers, so guess what? The price of the stock is going to go down. And think of it like this, right? If let's say you get these, you have these Jordans out, right? And if the Jordans are available in Foot Locker, right, in every Foot Locker in America, right, then guess what? All right, the price of those Jordans, all right, are not going to go up, right? They're not going to go up in price because there's more supply, right? All right, there's more supply than there is demand, okay? But let's say you got these limited edition Jordans, okay, and they're hard to find, okay? So you're gonna have more buyers than sellers. So guess what? Because there's more, right? There's less, right? There's more demand than there's supply. The price goes up. All right. So that's how you kind of got to look at the stock. It's all about supply and demand. When you have more people, okay, and look what happened. Look what happened. Look what's happening right now. The price of the stock is going down. Why? Because there's more people trying to sell than they are trying to buy. All right. If this was in reverse, the price of the stock is going to go up. And now that because I see, look, that these people are getting executed 538, that you see how look, because right now look what's happening. The price of the stock, right, is going down. Okay. People got to put in a lower bid. They're like, damn, man, I'm not gonna, I got to put less money because I'm not gonna get executed, right? And that's sort of how it works. Okay. That's sort of how it works. So then that gives you a sense of the direction of whether the stock is going to go. And these are the most important indicators, right? Level 2 and support and resistance, okay? Support and resistance and level 2 are always going to be the most important indicators, all right? Okay? And that's something you got to absolutely keep in mind, all right? When you're buying and selling stock, okay? All right, so with that said, all right, let's go down. So what scanning software I use? All right, I subscribe to Stocks to Trade. Okay, this is Stocks to Trade. It's a product that Tim Sykes actually created, and it's all right. I mean, I like the way the charts look. The charts look kind of good, but the indicators are terrible. But I like the fact that you get everything all in one screen. So you get you get level 1 and level 2 all in the screen. You get the time and sales tape and the news, right? Because you need a catalyst for a stock to kind of go up in price. And the reason why drives went up today is because they had this catalyst on today. They were announcing a comprehensive refinancing, deleveraging, strategic repositioning, and that kind of helped the price of the stock go up. All right, and that's why stock goes up or down in price based on news. Okay, so in this sense, this is pretty cool. But you see how Thinkorswim, you have these indicators. It's clean. On Stocks to Trade, look, I got the same indicators. I got the RSI and I got the MACD, and it looks terrible. They need to figure this out. If they can make this work, it would be much better. What I really like it for is more for like running my reports and my scans. So I have this criteria that I use in order to find my plays. And you're going to see 27 stocks appeared on my criteria. And I'll talk about it in more detail. So let me go back to my PowerPoint. All right. So it says I subscribe to Stocks to Trade. It's $140 a month, $29 a month. Honestly, guys, you don't need it. just stick with Thinkorswim. Thinkorswim is way superior to this. I got to this because I was learning, and Tim Sykes was like the first person that I learned from, and all he does is teach patterns. He doesn't teach you how to use any indicators, which I think it's a little suspicious because he uses indicators. Don't believe that bullshit that he's not using indicators. He uses some indicators, but he doesn't teach them. He just teaches patterns, which is the right way to teach. That's the way to go, really, to teach the patterns. That's exactly what I'm telling you, and I got that from Tim Sykes. But I also learned from other traders too. And there are plenty of other subscriptions. A lot of people use trade ideas. There's people in the group like Lucian, I think Daniel, Adams. They use trade ideas. It's awesome. It's way better than Thinkorswim. Could do a lot more. I'm sorry. It's way better than Stocks to Trade. But you don't need it. You don't need it. Honestly, Thinkorswim has everything you need. And the video that I did on how to set it up, that's all you need to use. I'm telling you, it's great. So if you can't afford to pay, I guess, again, Thinkorswim is free. I get a lot of questions about, do I need to have money in an account to open a Thinkorswim account? You don't. It's actually free. It's free. You don't need one. All right? There's also another one called TC2000. You can go to freestartcharts.com to kind of open a free account with them, and the charting software is awesome. It is. It's really awesome. It is. It's about as good as Thinkorswim. All right? But it's not as good as Thinkorswim, because Thinkorswim you can create all these scanners and stuff that you can't do with that. It's so much more advanced than anything else. But it is cool, and it does have a scanner. I think you can pay like $80 a month, and it's pretty cool too. But I don't think you need it. I honestly don't think you need it. But some people use it, and it's all personal preference. There's no right or wrong. All right. So why use scanning software, right? Without the scanning software, a day or momentum trader cannot trade without it. The scanner allows you to find stocks that are hitting new highs, new lows of the day, the highest and lowest percentage gators. Once you see a stock that has volume, percentage change, and it's worth taking a look at it, see if it's tradable. Once you do this enough, you begin to recognize the stocks that tend to move. They have sort of muscle memory. Not having a stock scanner is like driving a race car blindfolded. Honestly, it's true. That's how I do. So what happens is, in the morning when the market opens, I have usually my watch list somewhere here, right? I don't have it here now, but I usually have my watch list. This is my nightly scan. I just have it here as a scanner. This is my three candle gap scanner. This is the one that I use the most. And just watch the other video that I teach you how to set this up. And then this is like a new highs scanner that I use as well. And basically, when the market opens, I'm just filtering through this by volume to get a sense of what's going on, volume, or I'm looking at percentage change to see what's the highest percentage change. I click on the stock, and I just kind of get a sense of what it's doing. And usually what I do is, and I go through this in the other video. I'm not going to go into a lot of detail here, but I have two charts. So I go here, I click these two, and what I do is I make sure I link everything together. So there's these little links, and whatever you link your charts to, it automatically opens up the chart. So I just put red here, and watch. As soon as I do red, it opens this chart. And then this chart doesn't look like this one because you got to do a little bit of modification. So I just go in this little cog, and I go to appearance, and I just go to fill up, and I change my background to white, and I make sure I have my volume bars, and I click apply, and now it kind of looks the same. And then what I do is I look at two windows. So I look at a 3-minute chart and a 1-minute chart. And the reason why you want to look at the time frames is because these stocks tend to move so quickly that you need to get a sense of like when to buy and when to sell. And depending on the time frame you're looking at the stock, kind of you can get a better sense of what's going to do. So I tend to look at the 1 and the 3 because 3 I can kind of minimize my risk a little bit more. And what you're doing is, and what I do is I just add my studies here. I'll add this second window study. And basically, remember I talked about these indicators? So look what happens. This stock opens, market open. And based on this 3 candle gap scanner, this stock would have appeared at the close of this candle. And you see it kind of sold off a little bit, and then it kind of ran. And based on this, I might have jumped in on this, and I could have got in at 55 cents and sold somewhere in the 80-cent range, which would have been 30 cents. Now, because this stock is so cheap, imagine if you had a 10,000 share account, you could have bought like, if there's enough value, meaning if there's enough buyers, you could have got like 10,000 shares and made 30 cents. I mean, and 30 cents on 10,000 share position is a lot of money. All right, just to give you an exact number, just so you can get a sense of how much money you can make doing this, times 0.30. it's $3,000. I mean, and I've done it. I've made as much as 30 grand. All right, so in minutes. I mean, people do this every day, but obviously most people don't have that type of money when they open an account. All right, and you're gonna fall under what's called the pattern day trading rule, which I'll talk about in a minute. So you're gonna be limited in the amount of stocks you can buy and sell the same day. But basically, that's what I do. I just look at either my watch list and I have a plan for how I want to trade it, or I'm looking at stocks. I'm looking at new highs, or I'm looking at my 3 candle gap scanner, and I'm just clicking. I'm looking at charts, like right when it opens. I'm just looking, and I'm getting a sense of what I want to do. Where's the chart currently is? Like a chart like this. If I caught this right around here, yeah, I'm more than likely buying because it's very close to the 9 EMA, and it's gapping up. Okay, so and then what you do is you get a sense of what the stock is going to do. You when a stock is going gapping one way or another, you put a trend line. So you go like this, and if I see this gapping, I'm just putting like a trend line, and then I'm seeing what happens is once it breaks the trend, you get a sense that the direction of the stock is changing, and it kind of consolidated, and then it gapped up, and then it fell down, and then if it's going down the other way, and I'm watching it, I'm doing the same thing. I'm doing a trend line. All right, each way. So you can do a trend line when the stock is going up. You also can do a trend line when a stock is going down. So if let's say I see it here, I'm just doing the trend line. I'm just doing it here to see if it's gonna break. And you see, once it breaks the trend's your friend. You see, if I saw this here, I might have bought the stock because it broke the trend. You get the volume push, and then the price of the stock goes up. All right. So it's just giving you a sense of how I look at things. Okay. And get a sense of how I'm gonna buy and sell stocks. All right, we'll get into more detail in a second. Okay. So what daily websites what websites you should use to find plays and chart analysis? Finviz, Yahoo, StockCharts.com, Benziga, the StockMarketWatch.com, Twitter, Facebook, the Stock Tweets. These are all websites that you can go to kind of get a sense of what's happening throughout the day. It's important. You should be active on social media, not like talking and stuff, but just have a presence where you can kind of follow traders, like get a sense. Like I have a Twitter, and I hate social media. Just to put that out there for you guys, I freaking hate it. I'm only on the group because I enjoy the group, and I had a Twitter just to follow people. I never had any intentions of opening a Twitter account. But if I go, where is it?
I pulled up some videos for you.
What the hell is this? Pull up more videos. Let's go, where is it? Moments. So, where is me? I don't know why I can't find myself. But, oh, here it is. Sorry. But here's me, and these are the people I follow. So I go here, and I just follow people that trade. Some of these people don't trade. Obviously, Conor McGregor. I just follow him because he's cool. But I follow a lot of traders. There's Bullish Bears, our group. Salute. But some of these people are traders, and I follow them, and they always report sort of news. Okay. So you can go to my Twitter, watchotrade, and just follow all the traders that I follow. Not everybody's a trader, but most of these guys, a large portion of these guys, are actual traders, and I just follow these guys, and I kind of get a sense. So when I'm on Twitter, I kind of see like what people are saying. Okay, like look, EVOK up 60% post market. If you don't know, you could just kind of see these guys, and they're all posting the information here. Some people are selling. A lot of people are trying to sell their products and shit. But a lot of times, they tell you, look, like swing trader, and they're giving you some patterns and shit. But, a lot of these people are showing you, like giving you information, okay? And you just kind of get a sense of what's happening in the market, okay? So that's sort of what you should be doing, all right? So I also get questions about what brokerage to use. I use E-Trade. I'm opening TD Ameritrade account. Actually, I think I'm going to be doing this tomorrow. But there's other ones, and I think eventually I want to open a Speed Trader account because right now, when I trade stock, I'm generally bullish, meaning I'm buying a stock and selling a stock because I think the price of the stock is gonna go up higher than the price that I'm purchasing it. But I want to start shorting more because all these companies are dog shit. I mean, all these small caps, they suck ass. They're terrible, terrible companies. All right. So you see right now, like Ships is 540. Here's my prediction for tomorrow. It's gonna collapse because it's a shitty company. All right. So most of these companies that go up in price, they go up and then they collapse. Okay. This stock was worth $120. Like I don't know, a month ago, and then it went down to like $3. All right, so these don't be sold. If anybody is telling you buy this stock that's $1 because it's gonna go up to like $500, they don't know what they're talking about. We've had people in our group kind of pump like MGT. No offense to anybody in the group, and I don't know what they were thinking. But people are hyped because they think this guy, is a technology guy, and oh yeah, so it has to work. No, it's a bullshit company. They're not listed on the Nasdaq for a reason because they suck ass. All right, so just keep that in mind, guys. Just trade the momentum, trade the volume. If you're gonna do this, don't be holding these stocks thinking they're gonna go up to $1 million. They're not. All right, they're gonna eventually collapse. They suck. All right. The only stock that I've seen that's gone from like the when I was trading it at like $3 and $4 and is up now high is Ren. Ren is the only stock that I've seen hold its highs. Like if I look at this chart and I'm going to look at like the 1 year chart, like I was posting this. This is like when I was first in the group. I was telling people I was posting this on my watch list. It was like $3 and $4. This was back in like July, and look where it's at now. I mean, it's at $37. Oh my God! Now this is a stock. Had you bought 10,000 shares at $4, and it's worth 30, yeah, you'd be sitting pretty. But nobody thinks that these stocks are gonna go up in price, and that's why people don't hold them for long periods of time because they're dog shit companies, and that's what you gotta wrap your head around. All right. So trade the momentum, but speed trade, I want to open an account with them because they're good. Shorting stock, like a lot of times, you're not going to be able to do it. There's a lot of variables that impact shorting. Just YouTube shorting stock and do some research on your own. All right, so you can learn about shorting and why shorting stock is hard, and you're not going to always have the problem. You're not going to always be able to do it. But speed trader, they're really good with finding shares to short, and I think I'm going to open an account. But you need 30 grand to open an account with them. So if you're thinking about doing it yourselves, you're going to need a 30 grand, an account with a minimum of $30,000 in it. All right. But you also have interactive brokers, which are great. Their fees are low. Speed trader, their fees are low too. TD Ameritrade and E-Trade, they give you a flat fee. So it's like, when you open an account, it's going to be like $9.99 a trade. So when you buy a stock, it's $9.99, it's $10, and when you sell the stock, it's $10. So you're basically paying $20. So you're down 20 from whatever you bought, whatever your profit is. So if you made $100 buying and selling the stock, you really made 80 because you got to pay them. All right. Well, when you bought the shares and when you sold the shares, and but they're great. I mean, the executions are really good. All right, and there's no hidden fees. You know exactly what you're paying for. All right. And you can negotiate it down once you've been with them long enough. You can get them to like $6.95 to like $7 a trade. So something to think about. All right. So how much money do I need how much do I need to make money? Right. So I mean, you can start with as little as $500. To be honest with you, but you're gonna be very limited in your strategy. That means you're gonna have to focus on stocks that are cheaper. And the cheaper they are, the more volatile they are. So, but I think a good starting point is like 3 grand. If you can come up with you could do as little as 1,000, honestly. But 3 grand is a good starting point, I think. And be aware to lose it. Be prepared to lose it. All right. More likely you're gonna blow up your account once, maybe twice, maybe 3 times before you start making consistent money. All right. It takes a long time to get good at this. It's like any other profession. You gotta be really, really, really comfortable with losing, okay? Because it's until you get a rhythm, until you start understanding patterns and those types of things, be prepared to lose. So don't invest what you're not willing to lose. All right. But just know that if you open an account and you have less than $25,000 in that account, you're gonna be subjected to 3 day trades a week. So if you buy a stock and sell a stock the same day, that's considered one trade. So if I bought a stock and sold the stock Monday, that's one trade. If I bought a stock and sold the stock Tuesday, that's one trade. If I bought a stock and sold the stock Wednesday, that's three trades. That means I cannot make another trade until Monday, because the first trade I made that week was Monday, and I bought and sold that day. All right. Now, so make it even simpler. Let's say you bought and sold three stocks on Monday. That means you're done for the week. You cannot trade until the following Monday, because it's going to take 5 business days before you can make a trade again. All right. So how do you get around this? Okay. Just so you know too, let's say you're like trigger happy and you try to make a 4th trade or 5th trade, they're going to suspend your account for 90 days and you're not going to be able to make any trades. All right. It's a law that for whatever reason, it's a law in the United States. Hopefully Trump can reverse that. That'd be great. But it is a law, and so you got to keep that in mind. So how do you get around it? So you can open up accounts with multiple brokerages. So let's say if I had $6,000 total, and I said, I want to have at least 3 in each account, I can open an account with E-Trade, put $3,000 in that account. I can open an account with TD Ameritrade and put $3,000 in that account. So now I have 6 trades I can make in 5 business days. So to make it real simple, let's say I made if you make 3 trades with E-Trade, all right, on Monday, right, you're done for the week with E-Trade, because you just made your bought and sold 3 stocks on Monday. But you still have 3 more left in TD Ameritrade. So let's say on Tuesday you made 3 more trades. You made a total of 6 trades. So you made 3 with E-Trade, 3 with TD Ameritrade. You made 6, so now you can't trade again till next Monday. Well, at least with E-Trade, and then Tuesday with TD Ameritrade, because that would be 5 days. All right. Now, there is a way around this. You can open an account with SureTrader, and they're located in the Bahamas. There's no PDT rule, so you can open an account with like $500, $1,000, and you can trade as often as you like, but their commission fees are high. All right. So you need to make more money in order to make profit. But it is, I know people who use it and they don't have any issues with it. And it's pretty quick to open an account with them. So if you want to like start trading, which I don't suggest to do until you understand, like, and study and understand day trading. But let's say once you start feeling comfortable and you want to just kind of trade when you want, open a SureTrader account, put $500 in there, and just make very small trades just to get the feel, because nothing will prepare you for trading until you trade with real money, because the emotions that come with trading with real money, you cannot compare. There's no way you could replicate that. All right, it's just crazy. Like you'll see when you start trading with real money. So how do I set up my watch list? Each night I run a scan and look for stocks that are holding their highs, because the chance that they will be in play the next day is greater. All right. So remember, as momentum traders, you're looking for stocks that are going to move up or down big, fast, so you can make your money quick. So I look for stocks that kind of close the day holding their highs. That's what I look for. And the criteria I use is stocks that finish 7% or higher of the opening day price. They got a minimum value for the day of 700,000 shares or greater. It means volume means it's been traded the stock has been traded at a minimum of 700,000 shares, which is not high, but I kind of like to look at stocks that at 700,000 or higher, because I kind of want to, there may be like a stock lurking that's ready to break out, so I don't want to miss those plays. Also, I want to see that the stock has been traded 1,000 times or more, because let's say you see a stock and it had a volume of 700,000 shares, but you see 2 trades. That means 2 people bought and sold the stock. Like, you're not gonna be able to get buyers and sellers, right? Remember when I talked about level 2, bidders and asks, right? You want to see a bunch of people, a bunch of buyers, a bunch of sellers, all right? That way you can get executed quicker, all right? So that's why trades matter, okay? And then float is greater than 300,000 or greater. The float's important, so look this up and study it. Basically, what a float means, like a stock like Dries has a low float. Let me open the chart. I'll open it in Thinkorswim. So you see it says a float of 368,800 shares. That means that there's 368,000 shares that are in the market being traded at one time. And the lower the float, the faster the stock moves. Okay, a stock like Bank of America, okay? Bank of America, look what it has. It has, and it doesn't show it here, but it has 10 billion shares. Okay, float. So that means because there's so many shares out there that could tradable, the price of that stock is gonna move up slowly. It's not gonna move really fast because it's so. Look at this. It's like 22.95, and over here it's like 23.29. Right? It moves slower because there's so many shares on the market. But the less float, the lower the float, the faster the stock because there's less supply. So that means the demand is there and it pushes the stock up even greater. So float matters. Like when you should, it's important to look at float and to see that the float is low. The lower the float, the higher the probability that that stock is gonna move, especially when it has news. It'll move really, really fast. Okay, so that's what matters. So once the scan is finished, I open the chart and look for patterns and place them on my watches. Now, just so you know, Thinkorswim does not show you, unfortunately, trades, how many times a stock has been traded, or the float. All right, but you can find that out by going on like Yahoo Finance or FinViz. Okay, and I'll show you both. I'll show you stocks to trade real quick, and then I'll show you to show you how the stocks are pretty much the same. So right now, 28 stocks are in my watch list, and what I basically do is I open the chart and I look to see if the stock held its highs. DCIX, look what happened. It held its highs. This is going to be on my watch list tomorrow. Okay, Dries, which is we just was in. All right, held its highs. Let me closed holding its highs. I'm absolutely going to have this on my watch list tomorrow because it held its highs. Let's look at this now. Let me look at some bull crap stock. All right, I'm going to open this TIG. This would not be on my watch list. This did absolutely nothing all day. Let me show you another stock like EVOK. Let's see what happened with EVOK. EVOK actually is ripped. Look what happened. There must be some news on this because this thing went from 150 to over $2 post market. So after the market closed, this thing started running. So somebody's making some money. Damn, too bad I missed this. Making this video. See what I am losing money talking to you guys. Oh, GNK. It's another stock that a shipper. See, all the shipping companies are moving in unison because one company moved, all of them moved. And that's called a sympathy play. Remember when I talked about like the criteria that makes stocks move? Sympathy play, or causes a stock to move. Sympathy plays is when a stock price goes up or down based on another stock in the same sector. So just so you know, Dries, ESSA, look what happened. It opened at 140. It closed at like 260. That's a shipping company. Dries, another company, all right, that opened at like 390, closed at 560. Sino, it's another shipping company, opened at 277, closed at 415. Those are all shipping companies, all right. They all move in unison, all right. In penny stock land, that's why it's important. They will all be on my watch list tomorrow, all right. And that's what I do. So going back to my watch list, I'm just looking at stocks. So here's another stock, CBIO. There's another stock. I actually saw this earlier today, and I freaking I missed it. I should have played it. I saw it like somewhere over here, like in the 90-cent range. This thing went up. This thing hit 116. It hit a high of 138. Holy crap! I missed that. Ay. Oh well. But opportunity to make money. All right. I would, kind of like gapped up and then it kind of consolidated and it's at that whole dollar mark. So just so you know, whole dollar marks serve as resistance points. 50 cents, $1, $1.50, $2. Those are resistance barriers. Okay, so those could be support and resistance barriers. This may run tomorrow. I would probably put it on my watch list just because it ripped today, and it may just. Sometimes when stocks have when they rip, when they do something like this, they go from like 80 cents to like 140. They do it multiple days. So sometimes you can just put a stock on your watch list to say, hey, this stock ripped. I'm just gonna put it on there and watch it just in case it kind of moves again. All right. But basically, that's what you do. You just go back to your chart and you gotta look at stocks and just see, like EVOK, Sino. These are shipping companies that I showed you earlier, and this held this high. It's absolutely gonna be. And these stocks, we'll see if they run again tomorrow. Sometimes they run 1 or 2 days. Sometimes they run 3 days, and then they collapse. Then they go like this. Will by Friday, by Monday or Tuesday, this stock will be back at $2. So this 280, even less. It'll be like down here. Right? It's just inevitable. These companies suck. All right. And if I was to go on my Thinkorswim and I go to scan, and I go to my load scanner again, and I'm gonna do my nightly scan. Okay, and again, there's a video on this. Look, the same stocks that we see in my stocks to trade. So if you look at the stocks to trade, you see these stocks, these 28 stocks. Now watch, I go to Thinkorswim. Let's see, 35. It gives me a few more in Thinkorswim that it does in stocks to trade. Okay, and I'm just looking at the stocks. All right, here they all are. So you're just looking at them. Let's look at NDEV. So I go here, type NDEV, and it opened at 36. It closed at 46. It may go on my watch list tomorrow. All right, just to see. And that's how I build my watch list, because when stocks tend to hold their highs, okay, they tend to move. All right, they tend to be very volatile. And that's what I'm looking for. All right, I'm giving you all the secrets, guys. You know, these guys charge you a lot of money. These trading gurus, they charge you a lot of money. I'm giving you all this stuff for free. All right, so study hard and look at this stuff. All right, so that's why you use scanning software. Okay, and so an example of a chart I would place on my watch list. Again, this is a stock, DRIS. It held its highs. It opened here actually, right? And it closed here, right? It closed a lot higher than it opened, right? Held its high. So this is an example of a stock that I would put on my watch list, all right? And this line represents the breakout of the day. So at this point, it was the high day. When it broke this, it ripped, and that's when buyers came in and bought the stock, all right? And this is my Thinkorswim nightly scan criteria, all right? This is what I'm looking for: stocks between 30 cents and 50. This said $50. I actually got it down to $30. That are 7% or higher, that have a volume of 700,000 shares or more. All right, that's what I'm looking at. I don't even use this. Don't even look at this. I mean, in my video on it, I don't even have this there, so don't even worry about it. Okay, and this was a scan. This is a sample scan that I did on the 2nd for the 4th. This scan that I showed you guys will be the scan that I work off of for tomorrow. And again, Thinkorswim. If you don't have stocks to trade, which I don't recommend, you can use this. It's just as good. You can. This is what I'll be looking at to find out my criteria for my watch list that I'm going to use for tomorrow. Okay. So going back. All right. So, and then what I talked about patterns. Okay. So here's an example of a pattern. All right, that I would break out. So here's the stock when it opened. Right, it opened at 47 cents. It was a low of 47 cents. And right here, when it broke its daily resistance, this was a buy sign. People got in, and it drove the price of the stock up. All right, that was and this is on a 5-minute chart, right? Here's another chart. Okay, breakout. Here's a ASNA, right? Gapped up here, consolidated, and once it broke this high right here, this was a buy sign. People started buying the stock, and it drove the price of the stock up. Okay, that's sort of how it works. All right, we can look at some of these stocks in real time. Let's go here. And we looked at Sino earlier, right? This was another example, right? So the stock opened here. Let me move this over so you guys can see. Let's close this out. And oops, sorry. Let's go here. So again, right? This is the stock opened, right? Consolidated here, and once it broke this high of day candle, this is what brought it some buying pressure. Kind of went up and then sold off a little bit, consolidated. And then when it broke its high of day here, right, and this was the high of day, I'm sorry, at this moment, and then it kind of consolidated, and this became resistance, right? This is support, this is resistance, all right? And look what happened towards the end of the day, right? Because I said people trade 9 and 11, 2 and 4. This was about 3, this was at like 3, what time is it? 3:30. Look what happened. It broke the high of day, previous high. The previous high of the day was at 11:40, and people bought it and drove the price of the stock up. And this is the 9 EMA, and it's just riding up. I'll do daily, and when I do my daily recaps, I kind of like explain how these work in more detail, just so you know. I'm not going to go into a ton of detail today about them, but remember, when the stock is above the indicators, that's a buy sign. And look what happened here. It kind of hit the 9 EMA, and you see it after hours, and it's kind of riding it. That's not a coincidence, guys. That's because other traders are looking at this. All right. And what happened was, when it oversold here, right? You want to buy low, sell high. You see how far away the indicator is from the candle? So people waited for it to sell off, and once it hit the 9 EMA, look what happened. Some people started buying here. because they want to buy low and thinking that this is going to continue to go up tomorrow. All right. All right, that's not a coincidence, right? We could look at some other stocks. Tops. This is another shipping company. Look, it's called Held the Tide. It will be on my watch list tomorrow. All the shipping companies are. But look what happens, right? It opened, and at this point, this is the high of day, right? So you just put a drawing, put a price level here, just make it easy, right? And what happens once it breaks this high of day? It goes long. Now let's talk about dries, because I actually bought this and I actually lost money. So what happened was, right here at this point, it was the high of day. This was at 1020. And look, you can see it went for a second here. This stock, it broke its high, so I put a bid order once it went over the 443. And you see it hit a high at 448. So I got executed at 444 with a stop loss, I think, of like 435. You know, because sometimes these swing down and they go back up. So I kind of like to give it a little bit of space. But I put a stop, and what happened was it was a failed breakout. It didn't hold its highs. So I got stopped out, but you know, and I got stopped out for a loss, and then I went to the gym and I was dejected because at the gym I saw later on in the day that it actually broke it and held it. So it kind of attempted it at one time here, and it hit the new high, and then it kind of, so this became the new high over this candle. But you're gonna see that later on the day, all right, this is, so if you add a drawing, put a price line, trend line here, and you're gonna see at this point here, it actually broke the high and it went up to 465. You know, so my strategy was right. It was just, you know, it just didn't happen till later. It got a little bit of gas later on, and then it kind of consolidated, and then it kind of sold off, but then it broke out and then it ripped, and that's what you want to see. You want to see a breakout where it actually rips. Okay, that's what you want to see. You know, and look, people are still buying this stock. All right, look, people are buying this stock. If you notice, it consolidated and it's kind of here, but people are buying this, and they're buying this because they're thinking that tomorrow, when the market opens at 7, like at 6, people start buying. They're gonna drive the price up. They're either gonna try to sell pre-market, or they're gonna sell in the open, because the assumption is that people are gonna continue to drive the price of this stock up. But if you look at the indicators, right, what did I talk about? Look what's happening here. That rollover is happening. The green is going over the red, so this is probably may go down in price. Okay. We'll see. All right. Right now, there's more buyers than sellers, so that means the price of this stock is going to go up, right? Because there's more, there's you know, supply and demand, right? There's limited supply, but there's a lot of demand. So because of that, the price of that stock, right, should go up. All right. So we'll see. We'll see what happens tomorrow. It'll be interesting to see. All right. So that's what I trade out. Now I also trade breakdowns. All right, and I want to show you, I traded another stock. So this stock I took a loss in, but another stock I actually did really well in, and it was this stock. It was NUGT. Let me let's do 1 minute, 5 minute chart, and I'll tell you why I I actually bought this stock. It did. Let's see. It started failing here, and and what happened was, and this is, you're gonna learn this over time. So right, so it hit its high here, right, at 619, and then it hit another high of 602 right here. All right, if you're gonna notice, so it goes up and then it kind of gaps down, and then it goes up and it kind of gaps down and goes. So it hit a new lower high, and because the stock candles, remember I told you when they're above the indicators, that's a buy, that's more bullish. But you see how it keeps hitting this 9 EMA and it just bounces off it. So I said, man, the price of the stock is gonna go down, and basically when it touched, I think it was over here. So it went here and it like double top. So a double top is when it hits a high. So it hit a high here and it hit a high here, and it's hard to explain, and you gotta train your eye. But when it did this, where is it? Double top. You see how it's kind of going up and down, it's hitting, but it's not breaking it. So when I saw it do this, and it kind of hit its high here, hit its high here, right? I said, man, it's not breaking this. So I knew to go short, and I got in short, and I just wrote it down. I kind of sold like right over here. I made almost $1 a share on it, and you see how it just trended down the entire day. And let me just zoom out so you can kind of get a better sense of it. But you see how it just continued to trend down. So here, in these three candles, it wouldn't break it, and then that's when I knew these indicators was below the indicators. So I just wrote it down, and I closed my position somewhere over here when it started like gapping upward, somewhere in the 560s. I got executed, I think it was like 617, and I closed out at like 560. So I made like 40. I don't know. I forget how much it was, 40 something cents. It was, yeah. So it was a good trade, and I made some decent money on it. So and I went short. So what I just to make sure, right? Those other stocks, you buy and sell, so, right? So when I bought Dries and I sold it, right? And I sold it for a loss because I sold it lower than what I paid for it. But here I went short, all right? So because my expectation was the stock was gonna be lower, all right? I was betting that the price was gonna drop. It's gonna be lower than what I borrowed the shares for. So when I went to get executed, I did this, right? I went short. I went sell short, and I put the amount of shares, all right, and the price, and I hit submit. And I got executed. The broker allowed me to borrow shares, and then when I was ready to close my position, right? So I got filled in somewhere over here, and then I covered over here. So when I went to close it, I had to go to buy the cover, right? Because now I borrowed my shares when I shorted, and I'm buying the cover. Okay, down here. So and that's the price that I'm actually going to pay for the stock. And because I borrowed here and covering here, all right, I'm profiting, right? Because I'm buying it less than when I borrowed it. Okay, so that's what shorting means, all right? And I shorted, and I made money shorting. Okay, and I want to do more of that actually. I want to do more shorting in the future. All right. So with that said, let me go back. And where am I at this point? So this is an example of a morning panic / a dip buy. So dip buy means like when the market opens, let's see if I can find a stock that did that. I'm gonna look for something that kind of sold off in the morning, so you guys can see. I think Bank of America might have done this. Let's see. It kind of gotta happen like in the morning. This is sort of an example of it, but I want to give you a better example. Let's see if I can find it. It's gotta be something. Oh, I know what to do. Let's look for stocks that hit new lows. So let me go to so you can go here, and you can do stock top net top. Let's see. Top percent gain, yeah, top percent loss. Let's do that. And let's look at some of these stocks. Sometimes they break down, and then you see the dip buy. Let's see. Trying to find one so you can see. Oh man, none of these stocks are good examples. Crap. There's gotta be one in here. Come on, don't let me down, guys. This is sort of like a dip buy. So you see this stock VRX opened, right? And it sells off 9:30, starts selling off. It opened at 13.93, and then you see it just this is 5 minutes. So every 5 minutes it's dropping in price. It's dropping in price. It's dropping in price. And it kind of like went up a little, but then it keeps dropping. Once it finds its support here, this is the dip buy. This is when people start buying the stock. And here it went from 13.05 all the way to 13.27. All right, that's sort of a dip buy. What I use in my example here is a much better example where the stock price opened and it just like when it really drops in price super fast, like a lot of dramatically. Then what's going to happen is it's gonna find its support level, and people then buy the stock, because it's like a rubber band. When you buy a stock and it goes up really fast in price, then it's going to sell off really fast. And the same thing happens in reverse. If a stock kind of sells off at the open and then it finds its support level, people will dip buy it, and they'll buy it for a quick profit. Okay, and that's a morning panic. All right, and then look what happened. It kind of like. Then it sold off here, and then it finds its support here, and it finds its resistance here, and then you see the channel, and then look, once it breaks this, right, That's the actual. This is the new support levels. Once it breaks it, that's a short sign. So people went in and they shorted the stock here and they drove it down. All right, and then they covered somewhere in here. That's a breakdown. Okay, that's the opposite of a breakout. Okay. Here's another one. Here's REN. So here's a 5-minute chart. Stock opens, it kind of goes up, it kind of goes down, consolidates, and this was the low of day, right? This is the support level. Once it breaks support, you could have went short here, and this was, and it doesn't seem like it, but this went from like $35 to $33. So you could have made $2 a share shorting it. Okay, that's a breakdown. Okay, and what's that? Now this is the thing that I get the most questions on. So the two types of momentum plays. Okay. And pattern one, I think, and let's go through this. I think this happened this morning. I think it was ICBN. ICBN. Was it ICBN? I'm not sure if it was ICBN. Let's look at a chart here that kind of like this is sort of good, but it's consolidated. And I should have had this more prepared for you guys. Here it goes. Here's a perfect example, AMD. Alright, so let's look at this. I typically trade the 1-minute chart. This stock was on my watch list Thursday because it held its highs. I look for bull flag patterns. You usually get 2 pullbacks and then the sell-off, especially around whole numbers. The pullback is where you enter the stock, right? So let's look at this chart, AMD. This is a 5-minute chart. Let me see the 1-minute chart so maybe it looks more clear. All right, so this is what happens, right? This is a perfect example. The stock gaps up, and you see how it's far away from the actual indicators. So what happens is, right, and remember I talked about you put the trend line, so the trend's your friend, right? So you put the trend line, right, because you see it start gapping, and you go here. And what happens? Once you see how far away it is from the indicators, once it breaks the trend, it comes back. And what's happening is people are seeing the stock and they're saying, oh wow, this thing is starting to run. It's like at 1069, now it's here at 1080, this is great. But it's too far, I want to chase it. So what they do, they wait for the stock to pull back. And you see it kind of pull back, and it actually broke the 9 EMA, and it broke the 20 EMA, and it almost touched the 50-day moving average. You see how it did? But then people see it, and then they buy again. So it goes up, and it kind of consolidates, then it goes up, and then it kind of consolidates, and then it goes up. So these are entry points. Once it goes above the indicators, people are waiting for it to pull back so that they can find an entry, and if it stays above the indicator, which is the 9 EMA here, they just buy. All right, and that's sort of how it works. Okay, let me see if I can find something that was on the. Let's go see something on the scanner. PTCO. Let's see. See if this gives you a better. Here we go. This is what happens. Stock opens, right? It kind of consolidates. It breaks the high of day. It goes from 45 to 58 cents, right? Then it consolidates, right? And then people buy. Once it consolidates here, right, touches, and it goes up all the way up to 90 cents. And then what happens? The sell-off. So you get 2 pullbacks and then the sell-off. This is technically the first pullback, believe it or not. And there's the second pullback, and then it hits its high, and then it kind of consolidates and sell off. Just like I told you here, that's a typical pattern. All right, you notice here it gaps up, it kind of comes back to the moving average, right? So to the indicator. Then people buy, and then it goes up here, and then it kind of comes back again. Then people drive it one more time, and then it sells off. That's what happens again and again and again and again. You don't want to chase. Once it's had its 2 pullbacks, and you're not going to get a third one. On that third, you're going to see a little gap and then a sell-off. So you have to be very, very careful when you buy these stocks, all right? You don't want to be up here buying, all right? You don't want to buy high, all right, and sell low. You want to buy low and sell high. So when you see a stock gapping, you got to be careful. Because look, you see the indicators here? It's gapping up. You see that it crosses the lines, and it looks bullish, right? Very good. You see the indicators. When I said when they're separated like this is a great sign. But you see that the RSI is hot, it's over 70. So you know at some point it's going to sell off. And even though these were very bullish, look, you're starting to see the curl, and here's the sell-off. And you see that it sold off. And then it kind of did nothing the rest of the day. And then at the end of the day, what time was this? This was, it did nothing the rest of the day. That was its play. A lot of times you're going to get that rip and then that sell-off, and sometimes the stock does nothing the rest of the day. So that was an example of that. And then the other type is when a stock does a huge gap, there's no pullback. It just kind of like goes up and then it sells off. And I think this happened yesterday. I can't remember. Is it IGNP or IGND? Man, I can't remember the name of the stock. Let's see if I find it. I don't know, for some reason I can't find it. I know it was, damn, it sold off. And I saw it, is it INAP? I don't remember the name of the stock. I'm sorry, guys. I should have had this better prepared. But the other type of play that you're gonna get is a stock that's gonna. No, this is not it. Let's see. I'm trying to find. There's a great pattern where, look, if you see it here, see how it's going above and then selling off and coming back, going above and coming back, going above and coming back. But that's not the play I wanted to show you. There was a play I actually wanted to show you, the other kind. I'll find a better one, a better play. This is a great momentum play. Look what happens. It finds support, it goes up, you see the pullback. Here's the bull flag. It goes up, here's the bull flag, pulls back, goes up, and then it pulls back all the way to the 9 EMA, and then it just rides up. And people, this is where people are getting executed. They're too afraid to buy here because it's so far out. They want to see it pull back, and then they want to, this is where they get executed, they drive it up. And you see that everything is looking good, and it's clean, and this kind of went up all day, and you could have made some nice money trading the stock today. But the other stock play, and I'm sorry, is when a stock goes up super fast. Like if you see a stock go up like really fast, so let's say for like $5 to $7 in like minutes, it's gonna automatically sell off. There's not gonna be a pullback and then a gap up. It's just gonna rip and then it's gonna sell. These are the ones you gotta be real careful of. These are the ones where people lose their money in. They see the stock go up and it just like it's ripping super fast. There's no pullback. It just goes up like $1 or $2 in price, like in minutes, and then it completely sells off and washes out. So you gotta be careful about these plays. So those are the two types of plays that I look at. When I'm in here, I'm like getting in, getting out immediately. You have to be very careful. As a matter of fact, yesterday, what was the stock that I traded? I think did that. It was crap. Why can't I remember? It was something I trade on my E-Trade account. So damn. What was the name of that stock? I think I had it on my Facebook, but it actually like ripped up and like crashed all in the same moment. I can't remember, guys, right now. I'm sorry. But those are the two typical plays that I look at. All right, and these were the stocks that I traded with the indicators, and I talked about this. And this was nice. See, it kind of broke the high here, and this is where I kind of got in, and I saw it ripping, and look, it does the pullback, right? And then people look at the buying pressure. The buying pressure is here because it's extended, right? The candle's out away from the 9 EMA. It kind of came back in, and then it kind of went up, and then look, it sells off. Okay, and that's so. And look at this indicators. All right, so you can see. All right, here's another one. This is what I do. I look at the 1 minute, 3 minute chart just to get a sense of what it looks like. All right, and I showed you guys there's a whole other video dedicated to this that you guys can go through. All right, so. To leave this off, there's things to remember, right? Nobody knows exactly what a stock is going to do. All right, that's why traders use patterns to help identify stocks to trade. Anyone who tells you otherwise is full of shit. All right, that's the God's honest truth. Nobody knows what's going to happen in the market. All right, use the indicators and the patterns to give you a better sense of direction, but nobody knows. All right, have a plan when placing a trade. As soon as the stock doesn't follow your plan, cut your losses quickly using a stop loss. All right, you need to watch your stock. No guarantee you get filled. So I didn't really get into like stop losses and trailing stops and all that stuff. Just look it up. Study videos on it. All right. I didn't want to make this super long. It's long enough already. All right. All right. And then when we're placing a trade, make sure the stock has volume. The more volume, the easier. So you want it to be liquid, right? You want to have a lot. The more volume it is, the easier it is for you to get filled. Like NUGT today, I mean, it traded tremendous amount. Actually, I'll pull up my stocks to trade so you can see NUGT. Oh man, let's go here. All right, look how many shares it traded today. 107 million shares. All right, so it doesn't matter how many shares you buy, you're gonna get executed quick. But if you buy a stock like this ESSC that had only 278,000, I'm sorry, go back down. Like a stock like this GNK, which only had 229,000 shares traded. I mean, yeah, the stock held its highs, but wasn't a lot of people buying and selling the stock. All right, so it's going to be harder to get executed. So that's what I mean by that. Okay, all right. And for you newbies, you gotta remember, learn about support and resistance. What's the difference between level 1 and level 2? Learning the patterns, breakouts, breakdowns, red to green, green to red. What I talked about, dip buys. All right, flag patterns. Okay, everything that I talked about. Right. Use the scanner. Right. Use the Thinkorswim scanner. Watch my other video that shows you how to set it up. Right. And nothing really can prepare you though for trading. All right. Nothing can prepare you for live trading other than to trade with real money. Not like using the play account, which I highly recommend. Thinkorswim has a training account. Use it, but nothing's gonna prepare you to trading with real money. All right, and again, be prepared to kind of like blow up your account because you're not gonna get this right away. It's gonna take time and patience and just going through the emotions of trading until you get comfortable with it. All right, so be prepared to blow up your account. If you got $500 to lose, be okay with losing it. You got 1,000, 2,000, 5,000. Be prepared to lose it because it's possible that you're gonna lose it all. All right. So, and what your traders experience, right? So all traders lose, but what separates a winning trader from a losing trader is a winning trader cuts their losses quickly. Don't hold in hope, man, for rebounds. It's just better to cut your losses if the stock is not doing what you expect it to do. Like I did today with dries, even though it ran later. You know what? I'm okay with that. All right. I'm disciplined on cutting my losses. Okay. If you keep your losses to minimal, you're gonna make more than you lose, right? So don't give up. Again, if you blow up your account, try again. I mean, you cannot give up on this. Like, if this is life changing, it will change your life if you are disciplined, and you can make some real money doing this. But you gotta really stay at it, even if you're struggling. Okay, don't give up. All right, and then decide what type of trader you want to be. So this is a day trading video, but you may decide you want to be a swing trader, meaning you're buying a stock because you're thinking over a certain amount of days it's going to go up or down. All right, or you want to trade options. Options is completely different. Options, you're buying contracts, and contracts, a contract is 100 shares of a stock, and you can buy it over a certain time frame, and you can kind of close your position within that time frame. And if you're not sure what it is, watch some videos on options trading. Maybe that's more for you. All right, this is not for the faint of heart. I'm not gonna lie to you. Okay, so figure out what type of trader you want to be. Remember, look for those patterns that I talked about. Right, red to green, green to red. So this is an example of a stock that went from red to green. It went above the previous day's close price. This line represents the previous day's close price. That's a buy signal. Okay, NUGT. All right, that's one of my favorite stock. NUGT. All right, when we look at that stock. Come on. This is the previous day's close price. When it broke below it, that was a sign to go short. Okay? That's a bearish sign. All right? That's a sign to go short. All right? When people trade just like that, they look for stocks that go from green to red and red to green, and they use the previous day's close price as their stop loss, and they just let the stock ride all day. All right? There's people that do that. That just do that simply like this and not even look at the chart. I mean, and it works. It works. All right? For some people, it'll work. All right? And remember, look at those patterns. So, for example, DRYS. Let's pull that up. Okay. Okay, if we're looking at it, look what happened here. This is the 1 minute chart. All right, it gapped up really, really quickly. It went from red to green. All right, it went from 355 to 405, and this happened, okay, in a matter of 2 minutes. All right, but look what happened. It's so far away from the indicators that it pulls back, okay, and then it rips again. That's the bull flag. Look at the flag, all right, and then people get in and they drive the price of the stock up, okay. That's what people are looking at, all right. They're looking at stocks, and they're looking for entry points, all right, because you want to buy low, sell high. You don't want to buy a lot high and sell low unless you're shorting, all right. Otherwise, you're gonna lose your money, right. Look for the patterns, okay. You're gonna see the patterns. Look at the end of the day. Look what happened here, right. Gaps up, bull flag right here. Then it gaps up, bull flag, and then it kind of sells off and consolidates, and then it rips again. Okay, it rips again. Remember, people looking for those breakouts. So let me pull it up here so you can see it better here. DRYS. All right. Remember, this is a nice, easy example. Okay, here's the breakout right here. This is a buy sign. This is where people bought. And if you look at it closely, look, it gets extended, it pulls back, people get in, and then people push the stock price higher up. It broke out again. It's the pullback. People want to buy low and sell high. Okay, people look at this all day. And then what happens is when it gets its two rips, when it gets its like two rips, one right here, right? So here we go, 1, 2, and then I tell you, get on that third one, it's gonna sell off, and look, it washed out right here, and then it kind of just rolled VWAP. This is the VWAP indicator, and then it kind of ran up again. But then look what happened. It kind of consolidated for the rest of the day, and then when it broke the earliest day's high, it ripped a little bit right here, and then sold off. And then towards the end of the day, look what happens. Right? This is the higher day at this point. Right? This is the higher day at this point. And when people at the end of the day saw it break that, they jumped in. And look what happened. All right, they rolled it up, and when they see it out extended, they're looking for that pullback, that 9 EMA. Once it got there, it rolled up, and then they waited for that pullback. This is the 20 EMA. Broke the 9, hit the 20, and people used that, and then they rolled it up, and then it sold off. So this is just people taking their profit. People that bought here, taking their profit here. People bought here, taking their profit here. People who bought here, taking their profit here, and then people who are buying even after hours, they're still buying. And look where it's at now. It's kind of consolidating, going sideways. Okay, we'll see what happens. All right, it's starting to go up again. We'll see what happens tomorrow, right? So that's what we're looking for, guys. We're looking for those patterns, all right? So with that said, if you have any questions, hit me up on Bullish Bears on Facebook, and I hope you found some value in this video. Have a good one, guys.